Let me introduce him. Author of Bank to the Future, Simon Dixon, joins us from London. We have financial journalist Max Keiser joining us from Paris, and editor of the Executive Intelligence Review, Edward Spanhouse, who joins us from Washington. Gentlemen, welcome. Simon Dixon, first to you. Let's start with a warning from German Chancellor Angela Merkel, who warned against expectations of what she said quick or easy solutions. That's one day before EU leaders are meeting for a highly anticipated summit. A quote from her: everything else is doomed to failure from the start. At best, it is window dressing. Your reaction to that warning?
Window dressing, exactly what we've been doing at the moment. We're just seeing countries that are collateralized on each other's debt, trying to solve debt with more debt in a system that needs massive reform. And we're still trying to continue business as usual by solving debt with more debt. And debt with more debt has never been the solution and never will be the solution.
Max Keiser, a pan-European banking authority be put in place and give Brussels the final say over national budgets in the Eurozone. That's what a host of these officials, such as EU President Herman Van Rompuy, the European Commission President Jose Manuel Barroso, the central bank chief, that's what they've asked for. What do you think about this?
Well, to follow up on what the previous speaker said about collateral values and banks lending to each other based on presumed collateral value, the collateral value of these banks is constantly being downgraded. All of the bonds of these sovereign countries and these banks are being downgraded by Moody's and S&P, which means that the banks' balance sheets are being impaired more. And since the 2008 collapse of Lehman Brothers, we've had this global unwinding of all this bad debt, and to solve it, it would be like trying to catch a piano that's been thrown off a 20-story building. There's no way you can do that. There's no solution to this other than to let the system play out, let these debts find a market, because by simply trying to keep them afloat with more quantitative easing, more accounting tricks, more lending facilities, all that's happening is that a greater percentage of the population in these countries are being exposed to austerity measures for things that they themselves had nothing to do with.
So what do they mean, though, when they say a pan-European banking authority? Pretty much they want control as to what banks are going to do and to have oversight on them. Is that what that means?
Well, what it means is banks are sitting on bad debts. And instead of revealing these bad debts, they want to re-securitize them and resell them into a pan-European banking facility and pretend as if these bad debts are really good by re-denominating them in euros or outside of euros, or possibly from the IMF is talking about redenominating these debts in special drawing rights, which is the currency of the IMF. So they're looking of ways to kick the can down the road by expanding the debt on top of this shrinking collateral value, on top of a shrinking economy, on top of unemployment numbers that are getting worse and an economy that's getting worse. So they're exacerbating the problem, they're pursuing the wrong policies, and yes, social tensions are rising.
We're going to talk about that shrinking economy in a moment. Edward Spanhouse, Germany has reacted angrily to the U.S. president's criticism of the handling of the Eurozone debt crisis. The finance minister of Germany, he said that before giving advice to Europe, Barack Obama should concentrate on resolving America's own deficit, which is higher than the Eurozone debt. Does he have a valid point?
No, they're both wrong. This financial system is beyond salvation. You're dealing with $5 to $6 trillion of unpayable debt in the European banking system, and $1 to $2 additional trillion of unpayable debt in the U.S. banking system. But you can't even really talk that way because it's a globalized system, and it's really centralized out of the city of London. Obama got his talking points from Cameron, the British Prime Minister, and Mervyn King of the Bank of England, who basically told him what to say to Germany. And of course, Britain has had no love for Germany for about 100 years since Germany became an industrial power. But alternatively, the idea that the U.S. should deal with its deficit, as previous speakers alluded to, trying to cut a deficit in the absence of any real economic growth gets you nowhere. You're dealing with trillions of dollars of unpayable debt, and the only answer to this is to write this debt off in an orderly way, which means a reimposition of a Glass-Steagall standard, the Glass-Steagall law in the U.S., which separated the speculative side of banking from the legitimate commercial side. But there were also similar rules in effect in most European countries. And when those rules were abolished, the commercial banking system was essentially taken over by the gambling casino. And the whole thing is just one giant gambling casino at this point, and it has to be shut down, but shut down in an orderly fashion so you don't cause massive suffering for the populations of these countries.
Simon Dixon has a valid point that Edward Spanhaus talks about there, and that's in terms of the stimulus that the economy needs in the United States, which is hardly any. Some estimates $1 million is spent just to create one job in the United States. Why is it that the economy there is not being stimulated when you look at it, for example, as Edward Spanhaus said, the deficit in which it keeps growing and growing?
Because you have to remember, we're not asking the question of what's actually happening with this bank bailout money and these millions that are going to create one job. It can only be it has to be put to productive use. At the moment, the bank bailout money is trying to stimulate a property market, put it into casino banking and a speculative bubble, and trying to get back to business as usual, and also give it to consumers to take on credit cards. It's not reaching the small to medium-sized enterprise. It's not reaching the job creation sector, so it's not stimulating any growth. It's just simply propping up a system which is unsustainable.
Max Keiser, there have been other tools that have been used. Perhaps you could fill us in on them ever since maybe the financial crisis hitting 2007, 2008. Why have those tools failed? I mean, it's been now, what, 4 or 5 years since then?
Well, because I think that they draw the wrong conclusions and lessons from the Depression. The thing that got the U.S. and the world out of the Depression back in the 30s was the introduction of things like the Glass-Steagall Act that was alluded to earlier, and real banking reform and a Pecora Commission that put bankers in jail. Here, they are ignoring the predatory bankers, the kleptocrats that are destroying these countries and these economies, and instead they're trying to puff up or put a blood transfusion to a corpse. The banks are effectively dead. Their balance sheets are worthless. The only thing that keeps these zombies alive is a pretend and extend game between governments and bankers. I would say that additionally, what's remarkable is that if you look at some of these bankers on Wall Street, if they're looking to take over a country like Greece, they have an infinite amount of credit at their disposal at virtually 0% interest rates. We know this from what's been going on in Greece the last few years. It's been a wide open situation for outside bankers to come in with unlimited amounts of credit to destabilize that country. But if you live in Greece and you want to start a small business or you're trying to work in the economy, there's no credit at any cost, at any interest rate. And this is what I would call an example of apartheid, using interest rates, where if you're Greek and you're living in the economy, you're part of an apartheid system where you get nothing. You're treated like a second-class citizen. If you're a Wall Street banker under this financial apartheid system, your cost of funds are zero, and you have rights and privileges that extend beyond any constitution, that extend beyond any normal societal acceptable kind of behavior. So this is this global interest rate driven apartheid, driven by special interests on Wall Street, that's created an enormous global social problem that's erupting in ways that we have yet to see the full extent.
Well, Edward Spanhaus, if you want to look at some of the indicators in the United States, there are still very grim. I was trying to figure out what the housing market, how the housing market is doing. One report indicating that, the U.S., in terms of its mortgage applications, it has fallen for the second consecutive quarter. Another saying that it has actually grown. I mean, what is going on regarding, for example, the housing market in the United States? The news is varied in terms of the reports coming out of that.
Sure, it's still in collapse, and you're going to have these temporary ups and downs, but that tells you nothing. What I would like to expand on the discussion is to look at the physical side of the industrial economy, because that's what we're really dealing with. You can't understand this simply by looking at the financial side. And from the standpoint of the U.S. economy, which I know the best, you're looking at about a 40-year process of the takedown of the industrial economy. And you actually, this goes back to the assassination of Kennedy, and then in the 1970s, the Nixon taking the dollar off gold, ending the Bretton Woods fixed exchange rate system, that opened up the globalization and the destruction, certainly of the U.S. economy and really of all economies of the world. Secondly, you had something going on called controlled disintegration, a project of the Council of Foreign Relations called the 1980s Project, which was implemented then when Paul Volcker came in to head the Federal Reserve and raised his interest rates to 20%, which caused around 1980 a 50% collapse of key industrial sectors in auto, machine tools, and so forth in the U.S., from which we've never recovered over the past 30 years. On top of that, you have the green policy, the environmentalist policy, which came in around 1970. Again, we're looking at 40 years ago, which was also a takedown of our industrial economy by educating and teaching and propagandizing generations to say that science is bad, technology is bad for you, industry is bad, doing anything, building anything is bad. And you've had a couple generations now raised on this in the United States. So you're looking at about a 30, 40-year collapse of our industrial economy. And then, so you have to basically look at the two things. The industrial economy is going down, and the financial side, all these crazy financial instruments, derivatives, subprime mortgages, you know, you name it, are skyrocketing. So it reached the breaking point, and that breaking point was actually reached about 5 years ago, 2007, 2008. And since then, it's just been a patchwork of one type of bailout after another, which can only result in a hyperinflation. It cannot stimulate the industrial economy because the financial system's too far gone. The financial system is sucking everything out, any credit out that could possibly go into the industrial side. So that's why we say do a Glass-Steagall reform of the system. Just let the unpayable debts go. They're gone. Shut down the casino. And then you can get to extending credit for an actual industrial revival. But you'll never get the industrial revival till we pop the bubble and shut down the casino.
Simon Dixon, trying to understand the scope of things when we talk about the United States and when we talk about the Eurozone countries, how they work off each other in terms of the, obviously, the EU being the largest trade partner of the United States. The fallout there, how severely would it impact the U.S. economy and vice versa?
Well, it's almost impossible to actually know what's on these banks' balance sheets. All we know is the collateral of the banks and what they're issuing their loans are, which is moving into the speculative economy, is all based upon each other's bonds and each other's countries' debt. And they've all found markets for their debt in each other in order to continue this Ponzi scheme. And it's almost impossible to actually know. We're not really getting full disclosure of what the actual extent of the interreliability and how much debt they actually have of each other. So it's almost like waiting country by country. All I know is that what we're seeing right now is crazy financial management. We've seen the Spanish banking system requiring their 120 billion or whatever the latest figure is. And 20 billion of that has come from Italy, who are borrowing at 3% in order to lend at 7% and just, you know, things that aren't really making sense, and they're just delaying the inevitable on each other, and each country is living to a domino effect.
Max Keiser, perhaps an important point here, what Simon Dixon said, impossible to know what's on the bank's balance sheet. Why is that impossible? I mean, since the 2007-8 crash or financial crisis, shouldn't have there been a study on these balance sheets, or is it that hard to figure out what they have in terms of assets, in terms of tangible assets or their liquidity, et cetera?
Well, they have a name for it, don't they? It's called the shadow banking system. And Bloomberg just ran a report that the shadow banking system is greater than the visible banking system. During the run-up to the 2008 crash, you had a multi-trillion-dollar expansion in the global GDP, but you had many more trillions of dollars worth of derivatives building up in the shadow banking system. And banks make money trading these instruments back and forth with each other in the shadow banking system. It's unregulated. And as we just found out from Jamie Dimon over there at JP Morgan, occasionally we see some evidence of what's going on there. He had a $2 or $9 billion loss because one of his trader in London, again, London, as a previous speaker alluded to, is the center for this global financial fraud. Suddenly, we made visible something in the shadow banking system. Oh, Jamie Dimon's JP Morgan, they've got $90 trillion in derivatives on their balance sheet. That's almost 2 times the entire globe's gross domestic product, or GDP. Jamie Dimon says that it's perfectly fine, it's safe, it won't blow up, except when it does blow up, and then the government has to bail them out. And of course, there's a very tight relationship between Wall Street and the government. And to pay for the bailouts, they go to austerity measures. So the cost of health, the cost of food, the cost of energy for the vast majority of the population goes up to pay for the mistakes being made by what I call financial terrorists like Jamie Dimon.
Edward Spanos, Max Keiser talked about, touched on the shrinking economy. If we want to look at the economy shrinking globally, is that a valid point at this point when we look at, for example, how the Chinese factory output is really not growing as much? You have powerful European manufacturing, for example, countries like the UK decreasing in their output. And of course, we see how the US economy is stuttering. Is it because there's a shrinkage in the global economy?
Well, there is, but you have to make a distinction here. You referenced China. China is perhaps the most insulated from this because when everybody else was going to austerity, they were continuing to invest in infrastructure. And they have, therefore, both China and Russia are somewhat protected from this collapse. They're all subject to it, and they're all vulnerable to it. But what you have going on in the US and Europe it's a global. There's only one banking system. You can't say there's a US banking system or a European system. It's one system. It's centered in the city of London. And the British objective now and always is the destruction of national sovereignty. And what's being done right now with the demand for a super European bailout fund and a super authority means the end of national sovereignty in Europe. The Maastricht Treaty and the euro was already a big step in that direction. And you have to say that Germany is correct for its own reasons in resisting this. I mean, they know something about hyperinflation. But the British game right now is to blame Germany for all this. And of course, Obama, was right there behind Cameron saying the same thing. But it's the end of sovereignty. It's a globalized system. It can't be solved in one place. And Russia and China have somewhat kept their distance from this system, which is why they're in relatively better shape. But they will not be insulated from a complete financial disintegration, which could happen literally any day now.
Quickly, in 30 seconds or less, Simon Dixon, French president, is suggesting euro bonds to be used to borrow money with the debt guaranteed by the whole of the currency bloc. Do you agree? Is that a valid point he's got?
No, I completely disagree. Again, it's another product, another invention, another innovation of how to solve debt with more debt rather than let the system play itself out.
Okay, thank you very much. Author of Bank to the Future, Simon Dixon there. A financial journalist, Max Keiser from Paris, thank you. And editor of the Executive Intelligence Review, Edward Spanos from Washington with the statements. And thank you for watching another edition of the Press TV News Analysis. Any comments or suggestions, newsroom@presstv.ir is our email address to send it. From me, Kaveh Tahweh, and the entire team here in the capital, Tehran, it's goodbye.